Hi, welcome to Market in a Minute. So the market has Trump derangement syndrome, but we think it's coming to an end. I think the market feels too much like Lucy, pulling the football on Charlie Brown too much. And I think it's over it. I don't think they're going to fall for another Trump 50% tariff and then go down, and then he takes it off 2 days later. Obviously, he's negotiating publicly, and the market's freaking out about it. I think the market's caught on. I think the next time he does something like this, I don't think the market's going to go down much. Our view of what needs to happen for the market, we're going to go over that. I think if the playbook is set, that certain things have to happen, and we're probably going to go to a new high. And then the small cap biotechnology sector, we think it's set up for a pop, but that's not the way to invest in it. If you're going to do this, hire someone like myself that really knows what they're doing in the space, that can put 10, 15 good stocks together in a portfolio that can really outperform. So the stock market update. As we mentioned last week, we thought that this was a lot of fluff. This move here above the 200-day, and then the T there stands for Trump. So this is where Trump knocked the markets down. And then he changes his mind. This is where he pulls it back up. So in our opinion, there's too much of the Trump through here, all the way through here. This is Trump. I think the market's catching on that he's just publicly talking, and he's putting that out there, and he's getting a reaction from the other side. And unfortunately, we all have to deal with it, right? We have to deal with the volatility. But I think the market's kind of wising up to that, and I don't think the next time he does this, the market's going to come off very much. We think what has to happen is that the second quarter earnings need to be solid. I thought the first quarter earnings were fine. Those are good. NVIDIA reports Tuesday night, so NVIDIA has to have a reasonably good report. Technology is critically important for the markets. However, I think the market's going to start to find some new leadership. So we just need the technology sector to hang in there or still go up, but it's not totally dependent upon the technology sector. There's other things starting to move. So we want companies to give guidance. So when companies don't give guidance, the market can't focus out to 2026. And we think as we go through the year, companies will come back and start giving guidance because they'll be clearer what's happening with the tariffs. The tariffs are going to fade away. We think there's going to be lots of positive news coming now on the tariffs. The budget deficit, it needs to narrow, and I'll go through that, but it needs to be cut down to a reasonable level. And maybe the House bill did that, but it's not obvious to us. Bonds need to stabilize. So I think we're getting that. So you can see the 10-year Treasury here went from 4.6 down to below 4.5. It's ready to go through some of these moving averages. So the way to look at this is the opposite of a stock. So coming down is a good thing for the bond market. So as it breaks through these moving averages, hopefully it can gather some momentum and make it down below 4% at some point. So as bond yields fall, that's really good for the stock market. So the economy needs to continue growing, and it's close. So the first quarter is negative. Second quarter looks like it's okay, nothing to write home about. Then we want to see some acceleration as we go into the second half of the year. So these are the things that I think needs to happen to get a good run in the stock market. Coming into the third quarter and third quarter reports, and looking out to the second half of the year as we got a lot of this negative news from Trump behind us, and the economy starts to reaccelerate a little bit. So the big beautiful bill, it cuts the deficit supposedly to $3.3 trillion. So on the surface, I'm not understanding exactly how they get there, because we had $1.8 trillion last year in terms of a deficit. Now to cut it to $3.3 trillion over a 10-year period, maybe it's because of all the growth. But the Senate's going to take this. They're going to put their magic on it. for sure they're going to cut things back and hopefully cut the spending. We're running close to 7 trillion in spending, and before we went into COVID, we were in the fours. So, there's a couple $1 trillion of extra spending in there. We ought to be able to come to grips with that. And a lot of it is social spending, but we need to bring those down as we go through the next 10 years. The market needs this. We can't have $2 trillion in budget deficits per year over a 10-year period. Those numbers don't work. It'll be really difficult on our economy and our bond market as well. Stocks won't do a whole lot with rising interest rates over that period of time. So we need to come to grips with this. So right around probably when the third quarter starts in July, we're going to get a bill probably passed, and hopefully that's a catalyst for a move up in the stock market. Now, I want to talk for a second about this gross private domestic investment. So the economy has 4 major parts to it. One is consumer, one is government, another one is the imports versus exports. So the net imports versus exports, and that's been negative, but that's probably going to start to turn to a positive or not be a big of a negative. But the big movement in this in the economy, we think, will start with the domestic investments. So there's roughly $10 trillion that has been committed to the economy as investments, 10 trillion on a $30 trillion economy. So we're going to see a massive move in production and then more revenues being created by it as well. So that's really exciting. So we see that probably being the big driver of GDP growth in the next several years, and it could really bring down the budget deficit. Geopolitics, before the long weekend started, I thought, okay, maybe they're coming to an agreement. And then Trump comes out with this, Putin is crazy. So sounds like they're stuck. So that means maybe high oil prices and, maybe a total collapse of the Russian economy, or maybe even worse. But this may go back and forth. Maybe Putin is being really tough on negotiations as well. So we were hopeful. Now it's less hopeful. So maybe we have some Putin derangement syndrome going on here as well, rightfully so. And then Iran seems to be running out of time. So the Israelis took out the Houthis in Yemen. Now they're setting the stage to go after the Iranian nuclear sites. So I think if something doesn't happen really soon, like sometime, probably before the end of June, I think Israel will take out the Iranian nuclear sites. So I think the Saudis are on board. The Saudis probably agreed to increase production, and they'll probably cooperate as well when if something happens with the Russian oil not being able to being supplied as well because of sanctions. Tariffs. Kind of tired talking about this and looking at it, but we think that there is some good news coming. Vietnam and India probably are set up to be announced here shortly. So we're going to see just another tsunami of announcements coming in the back half of the year. And I think for the next, say, 5 or 10 of those announcements, then I think the market will treat those fairly well. So that's going to go from being a negative to being a positive. The economy, okay, the economy needs to hang in there. So we see a lot of catalysts coming, maybe better taxes, maybe lower deficits, the tariffs going away, all this investments in our country, more defense spending. So we think that all this tsunami of capital spending to occur will be really positive for the economy. Robotics will be needed to do all this manufacturing in the U.S. So there's a big capital spending boom. Some of those companies are going to benefit nicely. Autonomous driving is getting ready to be commercialized in our country. And so that's really probably a 2026 event to occur. And then in the near term, the 10-year and the 30-year just need to cooperate, just to kind of settle down, to stay in this range. And then I think slowly the housing market will come back. The Fed needs to take their foot off the throat of the housing market. That's, we're not seeing any housing inflation currently. It's estimated that U.S. homes went up 1.4% year over year in April. I think in May they're probably down. If it's going up, it's very little. A lot of markets are seeing contraction in housing prices. So it takes the Fed, how they calculate things, a while to get those numbers in place to see what's really happening in the housing market. So it's a lagging indicator, and we don't see inflation at this point really in the economy. And we're going to have some inflation reports in the back half of this week. The first quarter GDP being negative, but there are some really positive things that happened in that first quarter. It was a trade deficit that really knocked it down to being slightly negative. Now, the second quarter is looking at this is GDP, this is blue chip consensus. It's running about 1%. We think that this has been a better indicator than GDP now. Recently, GDP now is about 2.2% in terms of GDP growth for the second quarter. Then, as I mentioned, likely see an acceleration in the second half of this year and into 2026. Oversold sector, okay? Before I talk about that, the retailers report this week, a lot of retailers. And I went out to the outlet mall. Yeah, I'm cheap, right? I went out to the outlet mall and then I went into Gap stores because we like Gap stores. Store was really well presented, a lot of good value, lots of people in the store, and it was the absolute worst location in the mall. So I think Gap's going to be fine when they report this week, and that's kind of a secular stock for us. It's going to move probably nicely over time. We got a nice gain in it already. But I would also look at American Eagle. American Eagle, I thought, was really well presented. I actually bought some things at American Eagle, believe it or not. And we think that they are going through the same renovation as Gap and some of the other apparel manufacturers in the U.S. And again, we think Vietnam, we're going to come to terms with Vietnam on the tariffs, and that overhang of tariffs on the sector will go away. So we like biotechnology stocks, but we want to be really selective. So what we compare ourselves to is what's the XBI. So XBI is basically the emerging biotechnology sector of the market, lots of small caps, lots of companies in there you wouldn't want to own, right? However, we see the sector way oversold. It's been through a number of years of contraction, had a nice pop, and it's pulled back. And it broke through the support level back in December, and then went through the 200-day moving average, and then it looks like it's bottomed out, and bottomed out nicely lower, so roughly 20% plus lower. It bottomed out, and then now it's going back above the 20-day. It's close to it anyway, and the 50 days real tight with it. So it could have a really nice move here. As the market goes up in the second half of the year, probably be a lot of short covering this sector. This sector could go back to the old support level, which is the resistance, and that's about a 22% gain. So I think we're going to get some wind at our back. Now, this is how I would play the biotechnology group. Hire someone like me. We're probably one of the few advisors that has a very concentrated portfolio of biotechnology stocks. So we have 10 to maybe 15 biotechnology stocks in a portfolio. Right now we have 10 because we're seeing really good things out of those 10 stocks, and there's no sense in diluting our exposure to companies that we have a high degree of confidence in of their drugs getting approved. So having a high degree of confidence in when those things hit, they can move in a big way. Now, I always like to read all the research out there. We do a tremendous amount of research on the biotechnology sector. If you're an advisor and you want exposure to this group, don't buy a broad-based biotechnology fund because you're not going to get the bang for your buck. You need to get concentrated. We're happy to talk to you about it. Go to your back office and say, hey, I want this strategy on the platform. But we've got, as an example, I was reading Seeking Alpha, and then Seeking Alpha has an article on Anavex. So that's one of our favorite stocks. And the guy that did the research on it, he has the same view as we do. So I really like the article. So as it gets approved from the European Commission, probably by the end of the year, there's 10x upside in the stock. We agree with that. So Anavex is one of our bigger position. We have catalysts in all of our different companies that'll click this year. So lots going on in that sector. And if you need some exposure in that group, again, don't buy the XBI. Buy a concentrated portfolio. Either do it yourself or hire someone like myself to do the work. So we're in a transition period from a big correction in the overall markets back towards the new high. We haven't broken out yet, but we think if things go well, and we have a list of things that we're watching, plus more, but as things go well, we're going to probably break out to new highs and maybe even higher than that as we go through the year, and especially as we go into 2026. So we're always looking to be defensive, and I think that the Trump derangement syndrome on the overall stock market is alleviating itself, and that'll allow the markets probably to go higher. If you have any questions, ping me. Come to my website, Patrick M. CFA. Sign up for a hard copy of Market in a Minute. We'll send that to you every week. Take care.